Hello and welcome. This is Best Stocks to Buy Now. I'm going to go into detail about a stock I've recently found that you guys might find very interesting. So in this video, I'm going to show you how I found this investment, what I think it's worth, why I think it's so undervalued, the potential rewards and risks, and how to manage the investment for best results. So let's get to it. The stock I'm going to present today is PRDO Education Corporation, symbol PRDO. PRDO is actually an old Latin phrase for teach or to educate. How I found this stock is I started off with ranking all stocks by return on invested capital. The stocks with the highest return on invested capital had the highest scores, and then I separately ranked all companies by price to earnings ratio. Companies with the lowest price to earnings ratio got the highest scores. I combined those two rankings, and the companies that ranked the highest amongst them, I then drilled down to find the best companies with the best operating histories, and PRDO was one of them. Companies that match this criteria on average produce about a 15 to 20% annual return on your money going back to the 1980s. As of this recording, PRDO is selling at about $17.50 per share. Ironically, the day I wanted to do this video, it spiked up about 5%. There is significant evidence it's being accumulated by somebody. I can see it in the charts. The relative strength of PRDO is quite high compared to the overall market, which means somebody is accumulating the company. Now, they may be accumulating it just for long-term investment. They could be accumulating it to do a buyout offer on it soon. I do not know, but it's definitely being accumulated by somebody. As you can see here, it's up 5% today. So PRDO was founded in 1994. It was originally known as Career Education Corporation. Through organic growth as well as through mergers and acquisitions, PRDO eventually grew to have over 50 physical campuses throughout the United States. But thanks to the internet and the nature of the internet education market, over time, the amount of students that have wanted to switch more to online related education has grown substantially. And this has required PRDO to transition more away from physical campuses to more online oriented education. It's been a bumpy ride transitioning from those campuses to online, but the company has successfully achieved this. As of this recording, 97% of their students take online courses. The company has sold off a large number of its physical campuses and only has a few remaining. Okay, so let's get to the history of revenues. You can see in this chart going back about 5 years, it's been a nice, slow and steady growth in revenues. You can see estimates for 2023 and 2024 are in line with its recent past. Next, let's check earnings per share going back 5 years. Again, you can see a nice steady uptrend, including the two estimates for 2023 and 2024. Okay, so next let's check the profitability of PRDO compared to its industry. So we're looking at education service industry. There's 92 stocks that make up this industry. You can see our PRDO has got about a 12% return on total capital, which would put it in the top 7 out of 92. About a good percentage of these companies are actually losing money. I think it's about half of them are actually showing negative profits, interesting enough. But the story is actually a little bit deeper. PRDO has a significant amount of cash per share, about $8.66 per share. And when you factor in the amount of cash per share, which you can pay out to shareholders, the return on truly invested capital would actually be closer to 24-25%. So this is a much higher and much more statistically significant number and would actually put PRDO among the top 3 companies in this industry in terms of return on invested capital. Now, among the industry as a whole, since so many companies are losing money, the average return on total capital is about negative 5% per year right now among all of these stocks. Among the stocks that are actually profitable, however, the average return on total capital, just the profitable businesses, is around 18%. So next I'm going to do the valuation of the business. We're going to start with liquidation value to find out our downside. So here's the balance sheet, the most recent quarter's balance sheet. You can see we have about $568 million in cash and short-term investments, which are about as good as cash. Total receivables, current assets, total assets is about $1 billion. Now we have current liabilities, a little bit of debt in this company here. You have leases and so forth. Total liabilities are about $220 million. Total book value or equity, or also called net asset value, is around $800 million. However, in a true fire sale, a lot of the time you're not going to be able to get all of that $800 million. So let's cut a little bit of that up. Let's assume we are not going to get most of these long-term assets here, and we're going to do a little bit of calculation on that, paying back all the liabilities. I estimate that we have about $7.50 per share liquidation value in the business. So that's our possible downside. All right, next let's do the cash flow valuation. Now PRDO, as you can see, compared to its competitors, it's among the lower PE ratio in its industry. I won't scroll all the way down, but you can tell it's quite a bit lower. You can see here current PE ratio is about 8.9 times earnings for PRDO. However, when you factor in the large amount of cash it has per share, which works out to be about $8.66 per share, when you adjust for the amount of cash. So the reason I bring that up is if we went into the market and bought PRDO at about $17.50, bought the entire company, we could pay ourselves back the cash the company held in its coffers, which is equivalent to about $8.60 per share. When we pay ourselves back some of that money, our true effective PE ratio is about 4.4 4 times earnings. Put that in perspective, at that rate, if the company paid back its cash to all its shareholders and its performance continued in the future, we would average annual returns of around 22% per year just from the cash flow in the business, assuming no growth in the future. Now back to the PE ratio. The effective PE ratio is 4.4 times earnings. However, the industry average PE ratio among just the companies that are making money is 27.5 times earnings. Also, we need to compare PRDO to its 5-year average PE ratio, which has been around 10 times earnings. So factoring all of that into the equation, including the $8.60 per share in cash, I estimate the value of PRDO to be worth at least $28 a share. However, if the company is ever valued at the same multiples as the industry on average, it could possibly get up to $51 per share at the absolute maximum upside, I estimate. So that could work out to be a potential gain of $11 per share up to a potential gain of $34.50 per share. Now let's talk about the risks in PRDO. There's one major risk that's hit the company. It's the main reason the stock price has come down a bit and remained undervalued. So the major risk involved in PRDO is the federal funds program for education, which is actually utilized by the vast majority of PRDO's students to pay for their educations. There's been some rulings about repayments and debt forgiveness that the company has been dealing with a little bit, but most of the concern is just fears that these programs could be dramatically changed. From what I can tell, there doesn't seem to be a substantial concern, actual actionable problems that are occurring that we should really be worried about at this time. In my honest opinion, I actually think these concerns are a little overblown. Okay, so this kind of brings up an interesting point that I want to discuss for just a second, is that when you see news, positive or negative news, either about an individual stock or the overall stock market as a whole, in my experiences over the years, I can tell you that that logical reason is rarely the real issue about why the market is up or down or some stock is up or down. What actually happens is the news follows the markets. So for example, if in the case of PRDO is quite undervalued, everybody's wondering why. People involved with this process, whether it be analysts or journalists, try to dig around for any logical reason at all to explain why a stock would be down so much. And so they have two drawers. One drawer is positive news for positive reasons. Another drawer is negative news for negative reasons. They pick some story, they pull it out, and they announce it to the world that this is the reason this stock is undervalued. The same thing happens every day on CNBC. If the stock market's up 1%, then they open up the positive news drawer and they pick a story and they announce that story on the news as if that's actually fact. In reality, that's not really the real reason something's up or down. In fact, 99% of the time, we have no idea why the market or a particular stock is up or down. Okay, so I digress. Let's get to this. PRDO goes back to 2000 here. It started publicly trading. You can see it rocked all the way up to $70 a share. It's come down over the years. That turmoil it had over the last decade a little bit, hit it a bit, and you can see it got down to about $2.30 per share, got back up to $23 a share, and at the moment it's come back down to about $17 a share, and you can see this recent rise. That's why I'm saying it's being accumulated, and this is significantly stronger relative strength compared to the overall S&P 500, and that's usually a sign somebody is accumulating, or many somebodies are accumulating it, possibly for a takeover. Who knows what's happening? But considering that it's so undervalued, this company looks like a potential takeover target to me. So to show you it's a potential takeover target, in my honest opinion, you can see this here. Enterprise value relative to EBIT. EBIT is really looking operating earnings from the bottom up, whereas operating earnings are coming from the top down. There is a little bit of difference, but most of the time they overlap a great deal. Notice this little multiple over here. This is actually very low, and this is called the acquirer's multiple. So people who want to go buy entire companies can use this multiple because it includes the amount of debt, it includes the market cap of the company, and it subtracts all the cash a company has in short-term investments. And so the true acquirer's multiple here is so low that it makes this look to me like this company could very much be acquired. Put that in perspective with this acquirer's multiple. Now we're ignoring taxes, of course. If a company went in and paid all cash, just used equity to buy this business, they could make, in theory, a little over a 25% annual return before taxes, of course. That's pretty significant, and there's a lot of companies out there that would really like that. And considering that PRDO is selling about $1 billion market cap currently, this can be very appealing to a lot of companies. And just to compare to the overall industry, you can see PRDO right here. Out of 92 companies, it's in the top 10% or so, less than the top 10% in terms of the lowest valued. I'm not sure about these other companies, but I can tell you that this looks pretty sweet for companies in this industry considering the very low acquirer's multiple. So how can the company fix any major concerns that we have for its undervaluation and these federal funds programs? The answer is I'm not really sure they can. It's one of those things that they will do the best they can, but in the end, they're kind of in that position where there's not a whole lot they can do. They cannot substantially lower the risks as it is at this moment. moment. But I really doubt that risk is that high. Next, let's do a reward to risk analysis and expected returns. And to do this, I'm going to utilize a scenario planning technique I learned a long time ago that can really help us give an overall idea of what's possible with this stock. So I'm going to look into my crystal ball, and my crystal ball probably works as well as yours does, so bear with me. Let's look on the downside first. What's the possible loss? The potential downside for the stock is about $7.50. That's its liquidation value. That would represent about a loss of $10 per share. So if it get down here, about a 10% chance of it getting down now. That's probably grossly overestimating the chances of that happening, but let's just say that's the case. If you've been around long enough, you've seen everything happen, so that's how it works. All right, next, I think there's about a 20% chance it'll get to $10 per share. Something bad will happen. Who knows? We can't predict it. Maybe there's something happening with the federal funds. Something will shift. But let's say there's a 20% chance the stock get down to $10 per share, which would be a loss of about $7.50 per share. Next, let's say the stock doesn't really go anywhere. Maybe it dips a little bit from where it is today, goes down to around $14.50. So it drops about $3 per share. I'm going to estimate there's a 20% chance the stock will fall right back down a little bit and just hover around in this area, lose a little bit of money from its current position. So notice between those three scenarios, we now have about a 50% chance of loss. So I just want to estimate that to be nice and conservative. In my experience over the years, 50% chance of losing on any given investment in the stock market anyway is pretty normal. So that really protects our downside in terms of estimating the potential risks. So now let's look on the upside of what's possible. As I said in the video earlier, I estimate the valuation's around $28.50 per share. I'm going to estimate we have about a 40% chance of getting somewhere near $28.50 per share, which would represent about $11 gain from its current price at $17.50. Beyond that, I would then estimate that the potential return is a maximum of $51 per share. I think the chances of getting that high is incredibly unlikely, but there is a possibility that somebody will come in and pay that high for this stock, but there's a possibility there may be a bid or bidding war, who knows. But I'm going to estimate there's maybe a 10% chance of that happening, which is possibly too aggressive. But if that did happen, that would represent about a $33.50 per share gain in this stock. So you take all five of these scenarios, we jumble them and do some little math in them, and I estimate the potential expected return per share is about $4.65, which on a $17.50 stock would represent about a 26.5% return on our money over the next year or two. Not too shabby. Real quick, if you like this investment idea, you might want to check out ironoakcapitalpartners.com. Link in the description. There's more investment opportunities over there you might be very interested in. Now, how should you manage this investment once you have gotten into it? I would recommend owning it for a little past 1 full year. The reason you want to do that is you get capital gains tax benefits, so it lowers your tax bite, as well as it allows this investment to mature. Once you get to that point, you can reevaluate. If the company's still undervalued at that point, hold on. If it's properly valued, if it's come up quite a bit, or something is falling apart with the company fundamentally, go ahead and sell the stock. As for your position sizing on this stock, I'd represent putting just 5% of your total portfolio in this stock. For those of you who are more aggressive, I would not recommend more than 10% of your portfolio. It's just a little bit too much risk for that much. Next, I'd like to talk about how to get into the stock. I would recommend putting a limit to buy order at the prevailing bid. Go ahead and leave it there. It may take you a week or so, but there's a 90+% chance you will get filled at the bid, which means you will save the bid-ask spread, which can be a significant savings over time. When you go to sell the stock a year or so from now, go ahead and do a limit to sell order at the prevailing ask. Keep it in there for a week or so. It should fill 90+% of the time. If it does not get filled after a week or so, go ahead and readjust your limit to buy or limit to sell orders. Now I'm going to talk about psychology strategy, and what I would really recommend when you buy the stock, put a calendar alert in your phone or on your computer for a little bit past 1 year. When you get that alert in the future, you reevaluate the stock or you sell the stock, and you've effectively followed the system. In the meantime, I would not pay attention to the stock. Don't look at it. It will freak you out if you do that, because just stocks do what they do. They whip all over the place. One more thing, if you're enjoying this video, please hit that like button and subscribe, and I thank you for watching.